Thanks so much, Kelsey. And thanks to Cook County Higher Education too for having me today. My name is Claire Smith. I am a financial advisor with Edward Jones, and I'm presenting on the foundations of investing today because I know how hard it can be to get into the investing world and feel comfortable. I can't believe how many people are just expected to figure out investing on their own. So I hope everyone finds something helpful and or useful from the presentation today. So I think a great place to start our discussion about the foundations of investing is to answer the question, why do I want to invest? And to answer that question, well, it's going to be unique to each of you, but the answer to your why is the foundation for that investment strategy that's uniquely yours. And the answer to why will also help you better understand the strategy behind how.
Do you want me to run the poll question?
Oh, sure. Do we have a question?
No, just wanting to know if you want me to run the poll.
Oh, run the poll. Yeah, sure. Let's do that.
Okay.
I think we should. So we have a quick question. It's going to come through to you guys. You'll see it up on your screens. It's a poll question just to kind of get us started today.
And I do want to let everybody that's participating know that it's being recorded, but we are allowing for personal questions at the end. So that will be cropped out. So anything personal will not be included in this presentation. And you can now see the results of those that took the poll.
Great. Yep. So I think overall this is good. Some people have investments, some people don't. So this is great because we'll be able to adhere to a couple of different viewpoints here. Great. And then should we do the next poll too, Kelsey, or should we wait for a second on that one?
We can do it either way. Do you want to?
Let's go ahead and go through with that second one.
Okay.
Just a follow-up question here for you guys. For the one person. Okay, yeah, great. Thank you for answering that. That's great to see. So today we're going to discuss 5 basic rules that will help you form a strong foundation for investing. Those rules are: develop a strategy, diversify, stick with quality, invest for the long term, and focus on what you can control. So number 1 is to develop your strategy. And there are a number of tools to consider as you develop a strategy. And, choosing your tools is directly related to your why. For instance, some of you may be investing in an employer-sponsored plan, such as a simple IRA or a 403B, which is a good way to start saving for retirement. And many companies match retirement plan contributions, such as 50% of your contributions up to 6% of your salary. And you should always be taking full advantage of these contributions, enough to earn at least the full employer match on an employer-sponsored plan. You never want to try to leave free money on the table. And however, I guess when it comes to retirement, you may want to invest beyond your retirement plan through your employer as well, because oftentimes that might not be enough. So you may have other savings goals outside of that as well. It's not just retirement that investing always is related to. You might have a goal to pay for a child's education 10 years down the road, or you want to be prepared for emergencies. And investing in these areas looks a little bit different than investing for retirement. But the main thing to remember is that your investment strategy should be determined by your long-term goals and your investing time frame and your risk tolerance. And it can be difficult to stay focused on your long-term goals when there's a temporary market decline. Right now would be a fabulous example of that. And there will be other obstacles, such as keeping that priority to save month after month, even when you may be tempted to spend on other things. So as you make investment decisions, having that strategy will help you stay focused on the long term, so it's easier to stay on track. And going back to risk tolerance really quick, risk tolerance is also key to developing your strategy. Risk tolerance refers to your willingness or your comfort level with taking risk. And your risk tolerance is determined oftentimes by taking a questionnaire that's used to gauge how you might react in different situations. But gauging risk tolerance and your potential behavior is important because it's more likely that you'll reach your long-term goals if you don't abandon your strategy, right? So moving on to rule number two. Rule number two is diversify. So no single investment performs well under all conditions. And if a large portion of your portfolio is concentrated in one type of investment and bad news causes its value to drop unexpectedly, your long-term financial security may be in jeopardy. So there are several layers to diversification, and one is asset allocation. So this means dividing your money amongst different investment classes, such as stocks, bonds, and cash. And in fact, allocating your investments effectively is one of the single best steps you can take to improve your investment return potential, just overall. And a major study shows 90% of the variability of returns is determined by how you allocate your investments. So that just means the difference in your returns from year to year is largely related to your asset allocation. And as a result, asset allocation has a much bigger impact on your investment success than efforts to time the market by buying or selling stocks when you think that they're at high or low points. So to help illustrate the concept of asset allocation, let's take a look at the investment pyramid. So this shows us the different investment categories: cash, income, growth and income, growth, and aggressive. So at the lowest level of this pyramid is cash and cash equivalents. So this is going to be in relation to maybe your savings account. This is the money you keep for your day-to-day daily expenses, and can also be money set aside for investments. And if the money is kept in an account kind of like this, it's likely that there's a low interest rate on it and that you're not earning a lot on this type of an account. The next level up is income. This is made of investments that pay income, so such as bonds or CDs. And these investments generally have lower risk and return potential in relative to stocks, but they can reduce the overall risk of a portfolio when paired with stocks. And then stocks fall into the upper portions, the upper three portions of the pyramid here. So we have growth and income, growth and aggressive. And essentially the higher you go on the pyramid, the more your risk level increases. However, it also means the potential for greater returns. So that growth and income section, that refers to your large cap companies, those large cap stocks. These are the companies that have established themselves and maybe even pay a dividend to their investors. These are your 3M, your Amazon, your Microsoft, and such. And then the next step up is that growth category. That's the middle-sized companies that are hoping to become those large companies someday. This is maybe something like a Netflix was 10 years ago. They have that potential, and they've proven themselves. And then in the aggressive category, those are your small companies. So those are looking most likely internationally, and commodities also fall into this category as well. So when you hear diversifying your portfolio, that means owning a variety of investment types, and not being over-concentrated in any one type. So for example, let's say you wanted to invest in bonds. And bonds are debt securities similar to an IOU. When you purchase a bond, you lend money to companies, municipalities, states, and governments, and usually to finance a project or activity that they have going on. And basically you as the investor, you lend that money to the issuer and the issuer agrees to pay that money back to you at a specific date in the future. So your choices generally range from a one-day short-term investment to a bond that matures in maybe 30 years. And additionally, the issuer pays you interest, typically semi-annually, which is twice a year, until that bond matures. And most bonds are a $5,000 minimum investment. And in general, the longer the maturity, the higher the interest rate on it. So longer term bonds tend to fluctuate more than shorter term bonds. And there's an inverse relationship between bond prices and interest rates. So when interest rates go up, your bond prices tend to decline and vice versa. So if interest rates were to decline after you purchase a bond, your bond's market value will likely increase. However, the rise and the fall of your bonds values really are only important if you sell them prior to maturity. So that's just a quick overview of bonds. Let's move on to stocks. So, many people associate investing with the stock market, right? And you may have heard of bull and bear markets. It's a fun fact. The use of bull and bear to describe the markets actually comes from the way that the animals attack their opponents. So a bull thrusts its horns up while a bear swipes its paw down. It's highly cheesy, but it's just a metaphor for how the markets move. So when there is a trend that's upward, it's called a bull market. And when there's a trend that's downward, it's a bear market. So when you invest in the stock market, you are buying into a publicly traded company. So most people invest in the stock market in order to have a return on their investment. And two ways to do this are through the potential for growth of principal, known as capital appreciation, and dividends. And overall, capital appreciation is kind of the difference between what you pay for a stock and what you receive when you sell it, if it has grown in value. So for example, if you paid $20 for a share of stock and then you sold it for $30, your capital appreciation would be $10. And dividends are payments given to shareholders out of a company's earnings, usually quarterly, and can be paid in the form of money or more of their company stock. And stock dividends can be an additional source of income for you, but they can also provide the opportunity for growth. And so as you can see, stocks that historically paid dividends, shown in blue, outperformed the stocks that didn't pay dividends, shown in green. And you can also diversify your equities or stocks by sector. Stock market returns of different sectors can fluctuate. And if you're diversified, those fluctuations may not affect your portfolio as much. So for example, the technology sector is a good example. That sector had tremendous growth in the early 1980s, but then slumped with a downturn in the personal computer business and mainframe markets. And then in the early 1990s, however, there were major advances in microprocessor technology. So then that gave the tech industry a big boost again, and investors returned to the tech stocks. And then the slowing economy of 2000 and 2001 came and adversely affected technology again. The tech stock prices dropped. So if all of your investments were in tech stocks during that period of time, you would have ridden a roller coaster. And if you'd had some stock in other sectors such as healthcare or energy or financials, your portfolio may have been more stable throughout that time. So we've talked about bonds, we've talked about the stock market. So now we're going to talk about packaged investments, which include mutual funds, exchange traded funds, and unit investment trusts and other such investments like that. But I think we might have a question in the pool here. Kelsey, do you think maybe we should have that
Everything's been answered.
question?
You're okay.
Everything's been answered. Perfect. Alrighty. So if you guys have any questions right now, go ahead and submit them, and we'll take a question and answer here real quick. Otherwise, I'll continue.
I think you're good to continue.
All right, good to go. Okay, so let's keep going here. Let's start with an understanding of packaged investments. So packaged investments, such as mutual funds, exchange traded funds, unit investment trusts, they invest in a variety of stocks and bonds and or a combination of the two. So you receive this built-in diversification. And when you invest in one of these, your money is pooled with that of other investors. So for today's purposes, I think we'll focus on mutual funds as a good example of a packaged investment. And a good way to diversify by sector and asset class is to buy quality, professionally managed mutual funds. And a professional money manager or money management team then invests your money into a variety of securities in order to help the fund meet its stated objective, which, kind of going back to that investment pyramid, is, you know, growth or income, whatever it may be. So what are the benefits of mutual funds? They have that diversification. So most funds diversify their holdings by buying a wide variety of investments that correspond to their category. So a typical stock fund, for example, might own stock in 100 or more companies. And all of these companies have a range of different products and services that they provide. And the advantage of diversification is that losses on some stocks can be offset by gains on others. So you can further diversify your portfolio by investing in multiple mutual funds. They also have professional management. So each fund is run by one or more professional managers who are responsible for its day-to-day operations and performance. And a typical fund engages a large group of research analysts, traders, financial analysts, as well as a variety of other investment professionals. So this takes the burden of managing your investments off of you. Alrighty, so what are the ways that you can earn money in a mutual fund? So if there are bonds in your mutual fund, they could earn interest. And if there are stocks in your mutual fund, they could earn dividends. And the mutual fund will subtract its expenses and then pass its earnings on to you. So the second way to earn is for the share price of the mutual fund to increase in value as well. Basically, when a fund's management team sells a security at a profit, a capital gain is realized. And any gains are periodically paid to the fund shareholders in a capital gains distribution. So the stocks and the bonds owned by a mutual fund may fluctuate in value because of market conditions, which causes the value of the fund to fluctuate as well. But overall, at the end of the day, the management team receives their payment, and so do the shareholders. So rule number 3 is stick with quality. So if you Google, what should I invest in? You may get a lot of websites with tips on how to get into today's hot investments. And the best advice I can give is probably just ignore those, because investment fads such as real estate and gold are not sustainable long-term methods of making money. They're actually a fabulous way to lose a lot of money really quickly. So when it comes to quality, it can be difficult to distinguish one investment from another. So for instance, with more than 65,000 stocks available in the global market right now, it can be difficult to choose the right ones for your portfolio. And so how we sort through them at Edward Jones, for example, is we first filter stocks based on geography, longevity, size, and quality. And then from that group, we further narrow down the field by identifying companies we believe have sustainable competitive advantages, experienced management teams, and strong financial positions. And then if all of those boxes are checked, then we still want to make sure that the stock is priced fairly. So this process allows us to recommend what we believe are quality companies with attractive stock prices. So that's kind of the general way to narrow everything down. And in much the same way, bond quality is an important consideration when it comes to your investments as well. When you're buying bonds, don't be tempted by lower quality bonds that pay the higher rates. Although these higher rates might be attractive, oftentimes they come with an increased risk that the bonds will fail to make their interest payments. It's kind of why they do that. The higher rates on the bonds usually relates to higher risk, because they're willing to give you a higher rate because they possibly are not as safe as being in some other bonds. That's kind of the way things work. So stocks and bonds are just a couple of types of investments. They're two of the more common ones, but extending this focus on quality across all of your investments is a good rule of thumb, and your financial advisor can be helpful weighing your options as well. But in our experience, your investment success depends on buying and holding quality investments in a well-diversified portfolio and then maintaining a long-term perspective. All right, rule number 4 is invest for the long term. So remember that your strategy needs to help provide for not only you and your family today, but also for your goals 25 or more years from now. So let me ask, even before the recent market volatility, how many of you have ever felt a little uneasy about the stock market? Maybe just put a yes or a no into the question and answer. So over the past 84 years, the US has experienced war as well as economic and political uncertainty and upheaval. And in spite of these setbacks, our nation and our financial markets have persevered. Even during the 1930s, which was one of the worst decades for stocks, the stock market basically broke even. And in fact, in 2009, that marked the end of one of the worst decades for stocks, and it fell only an annualized 1%. So, however, a difficult 10-year period has historically been followed by performance. And I think the average is about 13.1% on average per year. So of course, past performance of the market isn't a guarantee to how it's going to perform in the future, but the market has always come back. And you may need to rebalance or make some minor changes to your portfolio to take advantage of opportunities when the market drops, but it's unlikely you need to rework everything in response to market changes. Because remember that the best asset allocation possible, it won't matter much if you don't stay the course, if you don't stay invested. So a great way to take advantage of time in the market is through what's called systematic investing. And although systematic investing doesn't guarantee a profit or protect against loss, it does allow investors to buy more shares when the price is low and fewer shares when the price is high. And this typically results in a lower average cost per share than if a constant number of shares are purchased at set intervals. And it's suitable for investors who wish to invest gradually over time to help average out that price. And this chart helps to illustrate how systematic investing works. So potentially you could decrease the average price paid for shares purchased over time, rather than as a lump sum investment. So for example, the first example assumes a $5,000 lump sum investment at $20 a share. And the second example assumes a $417 monthly investment for 12 months at various prices for shares. And in these examples, the lump sum investment, that produced an ending balance of 250 shares, each purchased at $20. And the dollar cost averaging strategy of investing $417 per month purchased a total of 300 shares, averaging at about $17 a share, which is about $3 less. So in this scenario, the investor purchased 50 more shares at an average price that was $3 lower than with the lump sum investment. All right, final rule, focus on what you can control. You can't control the economy, but you can control your saving and your spending habits. So you're more prepared for that rainy day. And while not the most attractive word, but budgeting can highlight where you're spending and ways to increase your savings. And it's also important to establish an emergency fund as well, 6 months worth of living expenses to guard against items like unexpected expenses or job loss is a general rule of thumb. And additionally, you can control your level of debt. Some debt is a necessary part of our financial pictures. For example, an education, a home, a car would not be possible for many of us, most of us, without borrowing. And so what I'm talking about more, on the other hand, is credit card debt, for example, can cause financial problems if not managed properly. And you also can't control the stock market, but you can control the way you respond when the stock market drops. And if you've invested in quality stocks and allocated your assets, you may not need to take any action anyway. And although we can't predict the future, historically, the market has rebounded. And you may actually want to use low prices as an opportunity to buy more shares while the market is down. And you can't control tax laws, but you can control the way that you use tax savings and tax advantages. And this can be done by choosing investments with different tax treatments. So there are 3 general tax categories: taxable, tax deferred, and tax-free. And the key differences reside in how and when these taxes are paid. And so tax diversification may help counter the ever-changing tax environments and help provide flexibility in retirement. And you also can't control the fact that every investment has some risk, but you can learn about your own risk tolerance and diversify your portfolio holdings to take advantage of a long-term view of your investments, rather than overreacting to short-term setbacks. And finally, you can control the quality of your investments, their diversification, and how long you hold them. So anyone can get carried away by emotion, but just don't make emotional decisions when it comes to your money. Stay invested. All right, so we've covered a lot in a short amount of time. How much time do we have? Okay, yeah, we're a little over. So I'll just recap really quick so that we can collect our thoughts. So rule number 1 is develop a strategy. Rule number 2 is diversify. Rule number 3 is stick with quality. Rule number 4 is invest for the long term. And rule number 5 is focus on what you can control. So at this time, I'd like to open this up for questions if anybody has any.
We don't have any currently, but please, again, use the Q&A in the chat function, or if you'd like to talk, I'm happy to have you use the raise your hand button and I will unmute you so you can talk if that's easier. So we have a question that popped up. This is all very overwhelming. How do I go about finding a reputable person to invest with?
Well, so it depends on where you're located. And so for here in Cook County, for example, I think I might be one of the only ones. That's what I do. That's my job, is to talk with people about investing and get invested in the right things. And so I am absolutely one of those people, but there are many companies. You can do your research, kind of figure out what your goals are and how hands-on you want to be. A lot of people kind of take it into their own hands nowadays. So you've probably heard of Robinhood or E-Trade or whatever it is. And those kind of apps are meant for, you kind of know what you want to invest in, and they're very low cost. If you're looking for somebody to kind of partner with you throughout the rest of your life, then it's better to go towards a financial advisor. So obviously I'm partial to Edward Jones, but there are a lot of financial advising companies that you can look into and chat with somebody.
She just says thank you, or they say.
Oh, good. Yeah.
Any other questions at all? Is there a great chance to ask them and have an opportunity? Well, with that being said, I'll leave it live for a couple more minutes just in case anybody wants to type in some questions. But we want to thank everybody for attending today and really appreciate you, Claire, for giving your time and knowledge to our
Yeah, of course.
tips and